Today we are going to look at Palantir through the lens of bulls and bears. And for your information, I currently own this share, and at the end of the video, I will explain what I plan to do with the shares looking at the latest valuation. Starting with the overall size of the company, Palantir's current market cap is around $430 billion, and because it currently has net cash position, its enterprise value is $420 billion. So roughly, we can say that the overall size of the company is about $400 billion. So keeping this number in mind, let's start with the first bull thesis. They focus that Palantir's growth is tremendous and it is very visible from its actual performance. In the last 12 months, the company generated $6 billion of revenue, and even though this is more than double from 2024 performance, compared to the $4 billion of the company size, the EV to sales multiple is about 65 times. So everybody knows this is very high number, but how do the bulls justify this? In order to do that, they focus on the most recent growth trend. So the company has been growing long before the LLM models arrived. But since the AIP launch in the middle of 2023, Palantir's growth started accelerating, and its revenue is exploding in the most recent quarters. As we can see this in the year-over-year growth rate chart, its second quarter revenue grew 93% compared to the year before. And if we divide the total revenue between commercial and government, the government portion is still bigger. However, the US commercial is growing at 149%, which is needless to say extremely high. At the same time, the US government revenue is still growing at pretty high speed at 90%. So based on this performance, the company is increasing its guidance. Compared to the numbers before the Q2 earnings, the new guidance numbers are about 6 to 10% higher. This is because the growth number is accelerating higher than what the insiders expected. In his most recent interview, Alex Karp, the CEO, stressed that the next 18 months are important, and he believes that 100% growth is still possible for Palantir. If you look at under the hood of this revenue growth, the customer count has increased from less than 150 by 2020 to over 1,000 in most recent quarter. And not only that, the company's RPO number, which is shown in the brown line here, is growing in line with the revenue as shown in the green line. And if we divide the RPO into short-term and long-term, we can see that the long-term RPO is growing faster than the short-term. And this indicates that customers are moving on from testing phase to actually using the Palantir's technology into their normal businesses. And this is probably the least important, but Wall Street is also increasing their estimate for Palantir's performance. And moving on to the second bull thesis, let's start by looking at the typical SaaS conundrum. Normally, when SaaS company wants to grow, it has to give up its margins because in the beginning, they have to provide free testings or large discounts so new customers can join and start using the services. But as the company grows to larger size, they want to focus on the margin, but at this phase, their growth will slow down. So there's always this tension between growth and margin for software companies, and that's the reason why people look at the rule of the 40 score, which is the sum of the growth rate and free cash flow margin. If this sum is at 40, the company is considered pretty healthy, and obviously the higher the better. But for Palantir's case, this number increased to 155, which is extremely high. And as you can see here, the trend is heading higher and higher. We can safely say that Palantir is successfully attaining high growth as well as high margin. So let's look at the margin in more detail. As we can see here, its adjusted EBIT margin actually accelerates, even though the growth is increasing at nearly 100%. And the same trend is true at its free cash flow margin. This is because even though Palantir is increasing its cost between 20 to 40% per year, its revenue is growing at a much higher rate. So per customer basis, since 2023, the company started to generate profit for each customer, and that gap between revenue and cost per customer is increasing as time passes each quarter. And another number that captures SaaS economics is the magic number. And this formula calculates for every dollar we spend on sales and marketing, how much recurring revenue is being generated. So if this number is less than 0.75, it's considered inefficient. But if that number is close to 1, then that company is considered to be generating healthy growth. And if that number goes beyond 1, it's considered a very attractive SaaS business model. And in the past, Palantir has struggled to go beyond this 0.75 hurdle. However, as we mentioned, since the AIP launched and customer adoption grew, this magic number has skyrocketed, and now it sits at 3.8 times. And as we can see here, It's not only the high number that it generates, but the trend is very attractive to investors. And long followers of Palantir knows that its CEO has boasted that Palantir does not need to spend so much on sales and marketing, buying steak dinners for its clients because its services are so good. And the actual numbers that we start to see since 2025 is proving that his claim is actually correct. And this efficiency is not only being realized in the sales and marketing level, but also in the G&A and R&D expenses. So as a portion of the revenue, these costs are going down, so the company's overall operating margin is increasing while generating nearly 100% year-over-year growth. And this 155 score puts Palantir ahead of top-tier companies, even NVIDIA. And the only companies that are surpassing Palantir are some memory semiconductor companies like Samsung and SK Hynix. But on top of this, there are a third factor that justifies this 65 very high multiple, and that is that Palantir does not need to invest large amount of money in order to generate AI growth. As you guys know, this is the most important chart that affects market sentiment these days. This shows how the three hyperscalers, as well as Meta, SpaceX, and Oracle, are investing in the data centers over the few years. One week, market freaks out that this number is so high, but the next week, market gets very excited from the high revenue that will be generated from these investments. But if you look at Palantir's balance sheet, its investment in PP&E is shown in the green here, which is just very small portion of the overall asset value, which is covered with the blue part, which is just cash sitting on its book. And if you look at the annual capex number, it's only at $42 million, which is compared to the overall size of the company, only 0.01%. And compared to the D&A, we can see that the capex is very stable, and compared to the free cash flow, it's only 1.3%. So basically, Palantir is generating high growth and high margin without any meaningful AI capex, which makes the ideal situation for AI investment. Now, let's move on to the bear thesis. The first part they focus on is the international growth. So as we saw before, the overall growth is very healthy, but the detailed numbers that we've looked at are actually focused on the US. So this is US commercial revenue growth, and this is US government revenue growth rate. However, if we divide this total revenue between international and the US, the picture looks a little bit different. Historically, Palantir has been generating between 40 to 60% into the US, and the rest coming from international. However, it is becoming more and more focused in the US. This in itself is not a big problem, but as we can see here, its international growth numbers are much lower compared to the US. So each quarter, this is another number that we should focus on to see if Palantir can generate high growth in international market as well as the US. And related to this, even though bulls focus on this very high accelerating growth rate, bears look at even longer term trend. So in the past, Palantir also generated very high growth rate, but this has stalled for several years going into 2023. This means that the very high trend that we see currently can also easily reverse to decelerating growth rate. And this can be also shown in the net dollar retention rate. In the past, Palantir generated very high 131%. However, this number also slid down to near 100%. So current 157 high number can always reverse its course. So the bears are skeptical whether the current high growth rate is as sustainable as everyone is expecting. And moving on to their second point is the adjustments that Palantir makes to report its earnings. And the biggest component is the stock-based compensation. Compared to its total revenue, it sits between 15 to 20%. And if you look at the absolute number, it is definitely on the increasing trend. And when Palantir adjusts its earnings, they basically add back this stock-based compensation as well as the tax expenses related to that. And here, bears are not saying that Palantir is somehow cheating or by making adjustments, the company is actually losing money, because even based on the GAAP basis, Palantir generates growing operating income as well as the net income. However, bears are indicating that the 155 Rule of 40 score that we saw before justifies 65 very high multiples. But if we take out these adjustments, Palantir's score falls below NVIDIA's. And on top of this, if there's any hiccup in the growth rate that we saw before going forward, then this 155 score can easily become much less impressive. And this actually becomes reality, then instead of giving a 65 times very high multiple, it can very easily go down at much lower rate, which is still higher than what normal companies are getting. And another issue with stock-based compensation that even though it is not shown in the income statement, the number of shares of Palantir is growing, and this can have negative consequence for long-term shareholders. And the third point that bears make is that the competition is increasing for Palantir. The high growth number that we saw before are actually without direct competition going after Palantir. However, in May 2026, which is just a few months ago, OpenAI and Anthropic announced very important news. That is, they're combining forces with large private equities in order to form deployment companies and sending forward deploy engineers in order to use products that are directly competing against Palantir. And this is significant because, as we saw before, Palantir has about 1,000 clients. However, the private equity firms that are working with OpenAI and Anthropic on these already has over 2,000 companies under their control. Since this news was announced in May, they still need several months in order to get this going. And during those times, Palantir can generate high growth. But once they are ready, Palantir has to directly compete against very large and well-funded competitors. And perhaps this is why, in his interview, Alex Karp focused on the next 18 months as a critical point for Palantir. And more recently, he's become very vocal, criticizing OpenAI and Anthropic. And that is probably because he's seeing that the competition will definitely increase in just few quarters. So today, looking at the financial statement, we've summed up the bull and bear thesis on Palantir. But in the end, for investors, the most important thing is, of course, the valuation. Especially for a very volatile company like Palantir, whenever market fluctuates even a little bit, the company's share price can move at a much larger swings. So if we actually make good valuation and deep understanding of the company, then we can utilize these low points that market generates for potential investors. And currently, even though S&P is hitting its all-time highs, Palantir is still lower than its peak, so there might be opportunities for new investors. That is why I built this valuation model of the Palantir. And here, in order to justify $179 per share, which is close to current market price, I need to have these 5 scenarios for the revenue growth as well as margins. And based on these assumptions, I'm predicting that 6 years later, Palantir's revenue will grow 20-fold, and it will maintain margin at 60%, which is definitely a notch higher than top SaaS companies out there. And in this scenario, Palantir has to generate the Rule of 40 score of 131 for more than 5 years going into the future. And this is a little bit higher than NVIDIA's past 5-year score, which is at 126. So the current price of $179 per share implies that things go pretty well for the company for the next 5 to 6 years. And if you want to get much higher profit, then things have to go much better than what I have projected in this model. So this valuation indicates that Palantir's current price is not very undervalued, so I would not buy this share if I am a new investor. However, at the same time, it shows that it's currently not egregiously overvalued. So if you already own shares of Palantir like myself, you could still wait out and see what happens. As always, this is not an investment advice, and I'm just sharing my research results. So please make your independent decision. And based on this, since I bought Palantir several years ago, rather than selling it now and paying taxes, I'm just going to hold on to it for a while and continue to monitor its result, especially the increasing competition coming from other large players. And if you want to play with the model that I have built and make adjustments to these assumptions and see how it affects the per share value of Palantir, please see the link below the video and check out the research platform that I have built. That's it for today, and please leave a comment on what you think about Palantir, as well as other AI tech companies that you want to see me analyze based on its financials. Thanks, guys.